Welcome to a video that I like to call the deep dive video, and I feel I need to explain this right off the bat. Every week I do a number of videos. I do a video each day, I do a weekly video, I do an intermarket analysis video. Then at the end of every week, I look through all of the charts and I pick out those that maybe I didn't really talk about in any of the videos, because sometimes we can still get some insight just by looking at these charts. Also, I didn't intend for this to happen, but this is also developed into a video where I have charts that are specific just to this video that really don't have a place in any other video. So I put the two of them together. This is the last video each week that I prepare. And then we put this together and present this to see, okay, is there something that we can get, if nothing else, than just being more informed about what's happening in the markets by looking at these charts. This is being prepared from Monday, February 12th. The first chart is a chart of the VIX, but you don't see the VIX on here. It's on here, but it's invisible. Over top of that is the blue line that you see, which is a 50-period exponential moving average. The VIX is supposed to be calculated using some static numbers to mark its range, 12 to the downside, 20 to the upside. Well, there are times when the VIX doesn't really stay within that nice, neat little range. There are times when we go above that range. We don't usually go below that range. But the moving average here tries to help us determine on a more dynamic scale, rather than using static numbers, what is the current range of the VIX. Back in 2007 into 2008, when we had the great financial crisis, the VIX really went up as stocks were going down, and we ended up going into a higher range. After that settled down and we started going back up, we settled into a lower range. After the COVID plunge, we ended up going into a higher range. And now that stocks are showing some improvement, we've been possibly setting a lower range right here. We don't use this to make decisions. This is more just informational, but it's still kind of a good thing to know. Also, we want to measure how fast is the VIX going. This is something that I do use in the daily videos from time to time. We use an RSI based on 9 periods to measure this. When the VIX is really going up, we will get an extreme positive reading. When the VIX is really going down, we'll get an extreme negative reading. Right now, we're not getting an extreme reading of either kind, so I haven't been showing this chart, and we're just kind of going down a little bit right now as stocks have been going up. Then we have a different study that we can look at. On top is the MOVE index. That measures the volatility of bonds. Then we have the VIX, which measures the volatility of stocks. And then in the lower area, the green line is the spread between the two, the VIX minus the MOVE index. And then what I look at is the correlation on the bottom. What we've been seeing lately is stocks and bonds they're having a rather strong tendency to go in opposite directions. That means the correlation has been going down, and we're kind of near the neutral point right now. So we really haven't been getting any insight from this chart. Then we look at the VIX and then a 3-month average of the VIX. When this is going down, that tends to be positive. When this is going up, that's more negative. When we started hitting some bumps at the early part of 2024, the VIX started going back up, and we're still within that 3-month range that's being measured here. Eventually, if we keep going up with the S&P, we would see this turn down, but it's rolling over just a little bit, even though it's really hard to see. But for right now, it's continuing to go up. So it's kind of contradicting the positive background that we've been in lately. Then we look at the VIX, and then we do a ratio between the VIX and the VVIX, or the volatility of the VIX. Also, when this is going up, that tends to be more negative. When it's going down, it tends to be more positive. It takes a while for this to really shift. You can see once it gets going in one certain direction, it tends to stay in that direction. We are turning over just a little bit. It's very difficult to see, but if we were to turn and go back down, that would be more positive. It's still having a tendency to go up, which again is contradicting more the positive backdrop that we've been seeing. Then we look at a long-term moving average based on 253 periods. There's roughly 253 trading days each year. I know we use the 200-day moving average. This tries to make it a little more specific. When this is going down, that tends to be more positive. When we started to hit trouble, we've been chopping around a little bit. And again, we're kind of going back up with this indicator right now. If we turn and start to go back down, that would end up being more positive. We look at a ratio between the VIX index and the MOVE index. And when this is coming down, and what I look at here is more the moving average. This just means the volatility in stocks typically has been declining overall when compared to bonds. as stocks have been going up. Well, we've been chopping around and we're right on the moving average right now. Then this is a fear gauge that we look at, and this is also kind of contradicting what we're saying. But at the same time, you go, wait a minute, maybe this is telling us something that our other charts are not telling us. We've been really going up with the S&P, and so when that happens, this is another fear gauge, and it has a tendency to really decline. Well, as we've been going up with the S&P, this has also been going up as well, which is contradicting what we're seeing in other charts. But at the same time, we're going, maybe we should just at least keep that in the back of our mind. This is another fear gauge. This one is declining. As stocks have been going up, this shows that fear has been decreasing. And this is a chart that sometimes is very helpful to us, but lately it's been so choppy that it's not really that helpful at all. This is a risk on to risk off ratio. When this is going up, that means folks are favoring stocks. When this is going down, they're getting more defensive, if not getting out of stocks and actually into bonds, even though that's not measured on this chart. We were going up as we were getting into the latter part of 2023, but since we started 2024, we've been really chopping around. Some days we go up a little, some days down a little. We're not seeing any kind of a defined trend right now. Then this just measures how far are we above the recent or the previous all-time high that we set. I started using this chart to show how far below were we from the all-time high, but since we've surpassed that, now this turns into a positive number. And since we did set that new all-time high and have been continuing to go up, in fact, we're above 5,000 now with the S&P. We're up 4.32% from the previous all-time high. That's just for information. This looks at the cumulative advanced decline line, and this really hasn't been moving all that much lately, but it's giving us some warning signs here. On top is the S&P, and that's been going up pretty nicely in a pretty solid uptrend. But you can see when we look at the cumulative advanced decline line for the NYSE, which is a broader measure of the market, we're having a difficult time just coming back up and getting above the moving average. Also, as this was going up, we were seeing a negative divergence with this study as this was going down. If we go to a regular advanced decline line, it is showing some improvement, but we're not necessarily breaking out. We're getting close and we're looking better, but this has been lagging a little bit. And this feeds into the idea that it's really been the mega caps, not the broad market, that's really been leading things higher. Here's another look at the NYSE advanced decline line calculated in a slightly different way, where it is showing some improvement, and we are seeing it in an overall uptrend when compared to the S&P. So this is more matching what we're seeing happening in price with the S&P. We want to see a good, healthy advanced decline line if the S&P is going up. If we start to see a negative divergence, that is a warning sign to us. And here's common stock, just looking at the NYSE, where again, we're hitting all-time highs with the S&P. We're not even breaking out above previous highs when we look at common stock on the NYSE just based on price. And we're also lagging even more based on volume. This is a little bit of a concern. So with both of these charts, we're seeing a negative divergence compared to the S&P. We're also seeing another negative divergence inside this chart where price is doing a little bit better than volume. You can see where it's coming back up, but not as much as price has been coming back up. Another little sign that gives us a warning. Then stockcharts.com has these thing called technical alerts. These are for the whole last previous week. When they're blue or green, depending on how you see the color, they are positive. When they're red, they are negative. We read this from the bottom up. When something positive happens, it's blue or green. When something negative happens, it's red. And we started out the week a little bit rough, both in Monday and Tuesday session. But you can see for the rest of the week, we just were off to the races. Here's where the S&P crossed above 5,000. Even Canada showing us a lot of improvement. And then the last signal to be triggered is at the very top. I look at these individually as they're being triggered, but at the same time, you can kind of see, okay, if we're seeing a whole lot of blue or green here, that means it's pretty positive right now. And we can know that without necessarily looking at all the other areas of the market at the same time. Then we look at 5 main indexes. The S&P, that's the foundation of everything that I talk about in my videos. Then we also look at the Dow because it's pretty important. We look at the NASDAQ 100, the biggest stocks in the NASDAQ. We look at the mid caps and the small caps. Stockcharts.com has this ability to, in an unemotional way, rate them on a score or a scale of 0 to 100. The higher the score, the better looking the technical chart without having to put our own emotion into any kind of a conclusion. Then we rate them from highest to lowest. And still, coming in first place are the QQQs, with a score of 93.7. So this chart has been looking the best for the most part. Ever since we really started bouncing up in October of 2022, it's been performing the best. In second place is the S&P 500, the one that I follow most, and it's coming in with a score of 86.6. In third place is the Dow, coming in at 77.7. It had a little bit of problems this week with some earnings reports that came out. It's only 30 stocks. So if you have one company that comes out with something that's negative, all 29 other stocks could be up, and that one stock could actually be dragging the Dow down. But currently it scores at 77.5. And we are seeing some improvement with the mid caps, where we were getting pretty weak. We were under 50. Now we started to see this go back up, and we're getting a score of 66.8 and still in last place, but showing some improvement because we were down around the 30s with the small caps. This is the IWM, which is the Russell 2000 small cap ETF, but it really shot up as we played out this past week, and we ended with a score of 63.6. You can pretty much wipe out the January effect off the table. You can see where the scores were just going down, 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 trying to improve and not really improving throughout the month of January. Now we are seeing some improvement, but we've been fooled by this before. We see a couple of good days out of the small caps, and then the next 3, 4, 5 days end up giving back a lot of the gains that were captured. Here's some short-term charts. We look at all of this. When I mean this, I mean I'm looking at the whole chart together, even though it's a short-term chart. These are a series of moving averages going from 10 periods to 50 periods, and to try to make it look a little nicer, the colors are all different. This is a short-term rainbow chart. Prices above all of the lines, and the lines are going up. This just tells us at a glance that we are in a solid uptrend because we're above all of the lines, and all of the lines are smooth and going higher. Then we look at a 20-period moving average study, and there are two different ways that this is calculated. There's a double exponential moving average study and a triple exponential moving average study. The triple moves faster, and that's the blue line here, and they're pretty much on top of each other. Right now, this is positive, and we're going up as price has been going up, so it's not really giving us any additional insight. Then we look at a regular 20-period moving average study, and I plot both a simple moving average, where each period used in the calculation is treated the same. Day number 1 counts as much as day number 20. And then we take an exponential moving average, where it's weighted more towards recent prices. And I plot them both on this chart. Prices above both the blue line and the red line, that's positive, and they're all are going up. Prices going up, and the two lines are going up. Another thing that makes this look more positive is we see that the blue line, which is the exponential moving average, it moves faster, and it's above the red line. So that's also giving us some confirmation that the uptrend continues for right now to be pretty strong. Intermediate term, we have another rainbow. This goes from 50 periods up to 100 periods. We're above all of the moving averages that are plotted, and all of the lines are comfortably going higher. This also suggests that the intermediate term trend is still strongly positive. Then we have the same kind of thing with a double and triple exponential moving average, but this is based on 50 periods. The red line is above the blue line. That tends to go faster here. And since it's the triple exponential moving average, and we've been hugging along this red line here, and that's also suggesting that the uptrend is pretty solid. Then we look at a thing called an anchored moving average, where most moving averages go from right now and then calculate looking backwards. An anchored moving average can go from a significant high or low and then go forward up to current prices. And this was the previous all-time high that we set. And when we were coming down last October, we actually got below this red line, but then we were able to bounce up off of that. We're far away from that line now, so I haven't been showing that chart. Incidentally, these other lines that you see on here, these are other anchored moving averages going back to COVID lows that we saw. This is a Connor's RSI, which is an oscillator. We look for extreme positive or negative readings. It's pretty spastic and in and of itself on a daily basis, but we don't get a lot of extreme readings, either positive or negative. When we're above the midpoint, that's more positive, and we're not seeing anything extreme right now, so I haven't been showing this. Here's a 50-period moving average study using both a simple and exponential moving average. Prices above both, and both lines are going up. we're starting to see the blue line just ever so slightly get above the red line. That's the exponential moving average outperforming the simple moving average, also suggesting that on a longer term basis, the trend is quite positive for now. Here's a 100 period moving average, also with the red line above the green line. That shows that we're going up strong and price is above both. Then how far are we away from the 200-day simple moving average? We're setting new all-time highs, and we're crossing above 5,000 with the S&P, so we're comfortably above that. This is standard deviation. This doesn't measure direction. This measures how fast is something going based on 10 periods. When we're going up above the moving average, that means the speed is increasing, and in this case, that would be up. When we drop below it, that means speed is decreasing, but it could be either up or down. So we keep an eye on this, but this doesn't really give us a lot of insight on a day in and day out basis. The mass index, it's not generating a signal right now. We only pay attention to this when it gets up to the red dashed line and the blue line. We're far away from that, so I watch this, but I don't show it in the videos unless it triggers some kind of a signal. We keep an eye on the S&P 100, which tends to be doing quite well right now, and the S&P 500, which is also doing well. And we're looking for divergences here. Right now, we're seeing more convergences as they're both breaking out to new all-time highs. This is a measurement that I do myself, so these numbers may not be exact. This is measuring from the low that we set in October of 2023 and how far we've bounced up to where we closed in Friday's session. Then there's some other areas on here just to measure what the percentage moves were during those times. Bollinger Bands are very helpful and very useful, and they can be used in a lot of different ways. When I use it on this chart, it's when we close outside of the either the upper or lower Bollinger Band. We're not doing that now. That's what the percent B indicator measures. When we are extreme positive, we're above this blue line. When we're extreme negative, we're below the red line. Another way that we can look at this that shows that things are positive is that we're above the midpoint and the midpoint is going up. We're also seeing the Bollinger Bands themselves start to widen out a little bit. That means the market's really moving more quickly. Then we have the CMB Composite Index, which is another oscillator that I use. We're not extreme positive yet, but we're getting close. If we see some more upward move from the S&P, this may become extreme positive, and I'll start to show that in a daily video. This is a point and figure chart where we don't take time into account, just price movement. Even though we're setting new all-time highs above 5,000, there was not enough in this chart anyway to generate a new X, but we are looking positive. When we're going up, X's are drawn. When we're going down, O's are drawn. The last signal that was generated was a double top breakout on November 20th, 2023. This is the Pring bottom fisher, and it's actually trying to cross over positive. This is pretty good when we've really been going down and trying to set some kind of a bottom, and we hit and then start to go back up. This is pretty good at picking out those points. It's actually crossing over right now, but we're going up. So it's like this signal is pretty much irrelevant. A long-term chart, first we look at a long-term rainbow going from 50 periods to 250 periods. All the lines are going up and prices above all the lines and also going up. So the long-term trend is also positive. This is the daily special K chart. This is a long-term oscillator. I mention this in every daily video, but we don't see very many signals here. So I wait and show it in this video where we're above the red line. So that is positive. Then we look at a weekly chart of the S&P on top, a weekly chart of the German DAX in the middle area. And we can see down here that the correlation between the two is kind of strong right now. It had been getting stronger. Now, they could both be going up or down. This just means that they're having a tendency to go in the same direction at the same time. Then we look at the U.S. 10-year yield on top, and we subtract the German 10-year yield. Since the U.S. rate is higher, we get a positive number. That's where the red line is here. That's above zero. And then just out of interest, we plot the U.S. dollar index here, but a lot of times there's a strong correlation between the top chart and the middle chart, but right now it's more neutral, so we're not getting a lot of insight from this chart. We don't have an awful lot of support and resistance areas to look at now. I usually do a whole slew of Fibonacci studies, but since we're breaking all-time highs, we're waiting for new tops to come in for us to measure new Fibonacci retracement levels. Plus, we haven't really fallen back with any real significance yet. This is another way of looking at support and resistance. This is a 20-period simple moving average of the open, high, low, and close. We're above what I call the mini rainbow here and going up. Sometimes when we're going up and we pull back, one of these areas may act as support. When we're going down and we start to bounce, one of these areas may act as resistance. We're far away from this mini rainbow right now, so there's been no real need to show this chart. Also, we're following what's called a 50-day cycle, and you can pick out any number of days. Over the last year to year and a half, this has been a pretty effective cycle, but we don't really know. It could change, and you could put in 72 days, you could put in 9.4 days, whatever you want here. We did see the last cycle that started on January 2nd, and we're kind of right in the middle of this current cycle. We look at a thing called the Ichimoku cloud, which are really just a series of moving averages that are based on current price and then shifted forward. When it's green, that's positive. When it's red, that's negative. When we're above the cloud and if we start to come down, sometimes this will act as support. If we're below the cloud and we start to bounce back up, it may act as resistance. Right now, we're far away from the cloud. Some broad market measures. Back when we were having more difficulties in the financial sector, we had a really strong level of support right here. We've been bouncing up as the financial sector has been improving, and we're far away from this support line, so I haven't been showing this chart. Then we're watching the Dow and transports, and I stopped showing the charts because every day it's confirming what we were already seeing, that the transports are negatively diverging from the Dow. And when the red line is below the black line, that also means the transports are underperforming. And then we have some other studies that we look at. But because we're just seeing the same thing every day, I look at the charts all the time, but then I don't show them in every video because I'm just saying the same things over and over. We also look at the FANG index, which is now setting, seems like day after day, a new all-time high. If we start to fall back, we're looking at these other areas as possible areas of support. And we look at a thing called the Vixen, where the VIX measures the volatility of the S&P 500. The Vixen measures the volatility of the NASDAQ 100. And I don't really use this bar chart here because there's a lot of erroneous data. I mainly look at the line chart. And as we've been going up, this has really been going down, showing that fear is really decreasing. And we look at a ratio between the Qs and the diamonds. That's the NASDAQ 100 and the Dow, and showing that their correlation between the two is pretty strong right now. They're having a tendency to go in the same direction at the same time. Here's the bank ETF. We want to keep an eye on this. It's been almost a year ago now when we got the bad banking news and we saw the bank ETF just really go down. Then it chopped sideways. Then things started to look better. Well, now we've got this New York Community Bank coming out with bad news. That's put some pressure on the bank ETF. We're also keeping an eye on regional banks, and we're wondering, is that an isolated case, or is there more news yet still to break? This is the regional banking ETF, and we compare it with the financial sector. And once that New York Community Bank news came out, you can see where it's really been underperforming, which is too bad because we were starting to see some improvement with this ratio, enough to generate a golden cross. But then this bad news has come in and taken price back lower. Then I have a couple of rate of change charts. These are just for information. Both of these look back 250 periods. This is a very long-term look at the market where we're going up with this chart and we're also going up with this other chart. We keep an eye on bonds where we look at 1 to 3 year bonds and we compare them with 3 to 7 year bonds. When this is going up, that means that there are a lot of interest rate fears out there. If you think interest rates are going to go up, you're going to get into shorter term bonds that mature quicker. If you think interest rates have topped out and are going to start to go down, you're going to get into longer term bonds like 3 to 7 year bonds. Well, when this is going up, that means that the Fed is probably not done raising interest rates. Then we hit a period throughout the spring and summer where it looked like maybe the Fed is done. And then we spent the latter part of the summer and fall going back up as the market kind of got caught trying to front run what the Fed was going to do. Then we hit that bottom in October and we saw this ratio really coming down as the market is pretty much assuming that there's going to be a soft landing, meaning that even though we've been seeing economic weakness, we're not necessarily going to go into a recession and that the Fed could possibly be pretty close to cutting rates. Well, now that the Fed has come out and said, well, we're probably not going to raise rates anymore, but we're not quite sure when we're going to cut rates. So for right now, we're just going to leave them where they're at. We've been seeing this ratio starting to go back up. So there's a little bit of fear starting to come in. Another thing that we've been seeing, especially later in this past week, is that stock prices were going up and interest rates were going up together. In this kind of an environment, they have a tendency to go more in opposite directions. Then we do an inverse where we look at further out bonds and compare them with shorter term bonds, where when this was going up, that means folks are trying to lock in longer maturity rates as this is outperforming. Now it's starting to go back down as there's some uncertainty about what's going to happen with interest rates. Then we look at the TLT, which is the blue line up here, and the S&P, which is the red line. And we're seeing where the longer term relationship is really starting to weaken for quite a bit. Pretty much from October through the beginning of 2024, they were having a tendency to go in the same direction longer term. You can look at the chart and see where the S&P has been going up as bond prices have been going down. And that's feeding into why we're seeing this decline. We're also seeing in a shorter term time frame based on 10 periods where this relationship is getting weaker as well. What's going to happen here? Are stock prices going to need to pull back and justify interest rates going higher? Or are interest rates going to come down and justify stock prices going even higher than where they're at right now? That's the question that the market is trying to answer. Let me look at another correlation between the QQQs, which is the NASDAQ 100, and the TLT, which is the long-term bond ETF. They had a pretty strong relationship going into the end of the year. Now it's coming back down to neutral as they're having a tendency to go in opposite directions. Bond prices are going down as the QQQ has been going up. Here is the yield curve. What we're watching are the 10 and the 2 and the 10 to the 3 month. They're still inverted for right now. It's been this way for anywhere from 1.5 to about 2 years now. And then we look at TIPS, which are Treasury inflation protected securities. You get into those when you think we're in a rising interest rate environment where inflation is also a concern. When that was happening, we saw TIPS really outperforming 3 to 7 year bonds. Then we saw this ratio start to come back down, and we pretty much have been chopping sideways right now. It's a little more pronounced when we look at this chart, where we look at TIPS and we compare it with further out bonds. TIPS were outperforming as we were going up. Then we started to go sideways. Then when we hit that bottom in October, this really started to come down, meaning that the 7 to 10 year bonds were outperforming TIPS. But now we're chopping around and actually starting to go back up. Even though we're in a longer term downtrend with this ratio, we want to see how this plays out. And then we look at cash and we compare it with 3 to 7 year bonds. It had been coming down, which you would think 3 to 7 year bonds would outperform, especially if interest rates are coming down. But now this is starting to go back up. But we've seen a recent death cross here with this ratio. So the bond market compared to the stock market is giving us some real uncertain signs right now. And then we look at home construction and we compare it with bonds, where the home construction area has really been outperforming bonds. And you would think if we're in a real rising interest rate environment, because this is a very interest rate sensitive part of the market, that this would really be going down. So this gives us a little bit of hope, saying that this is showing that the home construction is outperforming. And then I have things called the possible positive scenarios. I have a number of charts. I don't know the number, maybe 10, 12 different charts. A lot of those I've been using in the daily videos. What I'm going to show you here are the charts that I haven't been using in the daily videos, because sometimes we can still get some insight. The first one just measures the percent of stocks in the S&P 500 that are above their 200-day simple moving average. Even though we're hitting all-time highs and we're breaking out with the S&P, we're declining with the 200-period simple moving average study. That's a bit of a negative divergence and kind of a concern to us right now. Then we look at the S&P and look at a shorter-term moving average, 50 periods, where we're breaking out with the S&P. We're also going down in a negative divergence here with those stocks above their 50-day moving average. Another concern that we're seeing. Then we look at the mid caps, where they topped out at the end of 2023, been coming down. Also, not really negatively diverging because we're not breaking out with the mid cap index, but we're not really showing an awful lot of strength here. And then we look at the small caps, set a high at the late 2023 stage, coming down, showing more weakness here, but the index itself has been under pressure. Then we look at a 19-day exponential moving average, the advanced decline ratio. We're above 0 based on price and volume, so that just means this is more positive. Then we look at a 50-period exponential moving average study of the new highs minus the new lows. And yes, this is a moving average of a moving average, which is a cardinal sin of technical analysis. That's kind of why I do it. But that's just a little rebelliousness that I have, because this is a 50-period moving average of a 50-period moving average. And when this is above zero and going up, that just means longer term we are positive. Thank you. I really hope you found this helpful. You might find this video interesting, but it's kind of like a leftover video. If you really want to see some of the analysis that I do, please go watch the daily videos and at least go watch the weekly videos. And if you're interested in that as well, check out the intermarket analysis video. And I prepare these every day and every week. So I hope you find them helpful. I also hope that you have a really good weekend, and I will talk to you in the next video.